So here's what I want to do. All right. We would started talking about earlier about lowering the interest rate. And I said by lowering the interest rate, you actually make it harder to pay off the loan. So let's take a look at two loans. We're going to take a look at a $350,000 loan at 4%, 360 months. And, and we're going to take a look at another loan at 3%, lowering the interest rate. All right. So when we calculate that, all right, 1475.61. All right, so we have at 350,000, 4% for 30 years, 1670.95. Okay. And then the payment at 3% is 1475.61. If we scroll down, the bank wants on this loan $181,000. All right, there we go. 181,000 total interest cost on the loan for 30 years. And on this one, the bank wants 251. So it looks like the lower interest rate is winning all around. We have a lower interest cost for 30 years and a lower payment. Okay. But let's look at when we take a look at this $350,000 loan, let's take a look at the principal payments. Okay. So if we make a payment here on our very first payment, and then the second payment starts out with a principal payment of 505.96. If we make a payment in January, then this would be our principal payment for February. If we pay that early, then we eliminate line number 2 on our schedule because we're paid down to line 2 in January by paying an extra 505.96. And we eliminate this interest on line 2. And then our next mortgage payment for the next month is actually on line 3. But if we lower the interest rate, look at this. Look at my next principal payment. It's $602. So when you lower the interest rate, you actually make it harder to get rid of a payment because we attack the loans with the principal payment. So when the loan officers are trained, if you come into the bank, start talking about, I want to pay the loan off early. They said, well, if you want to pay the loan off early, let's try to lower the interest rate so you'll pay less interest overall. And then you walk out saying, I made a good deal. But when you try to pay the loan off early, look what happens. I'm going to take a look at this where we have $7,000. If we prepay about $7,000, we knock off about 14 payments at the higher interest rate. Are you seeing that, folks? 14 payments at the higher interest rate. When we lower the interest rate to 3% instead of 4%, $7,000 only knocks out about 12 payments now. Do you see what I'm talking about? Your money doesn't do as much work when you lower the interest rate. The bank owners understand that, but the people who work in the bank do not. This is why you're always offered a lower interest rate if you're trying to pay off the loan faster. Here's what I need for everybody to know. You don't need the lowest interest rate. You don't need the highest interest rate. What you need is the right interest rate for you and your family or your business or your church or whatever you have that has a mortgage or loan on it. You need the right interest rate that's going to benefit you according to your income. That's how we figure that out. So with the P.I.L.L method, we have people on staff that will work with you to help you to figure out what the right interest rate is for you. And then we'll plug in everything into the P.I.L.L method to figure out when you can be debt free by optimizing your interest savings. So having the loan set up the right way is more than half the battle. But if you're already into your loan, don't worry about it. We will help you from that point. If you're not in your loan yet, please talk to us first and let's help you to set up your loan. Okay. And even though there's going to be a consultation fee, the amount of money we'll save you, oh my goodness, the consultation fee will seem like pennies. So listen, folks, get some help, set these loans up right, put them in the P.I.L.L method, save an average of $150,000 to $200,000 in interest, pay it off in 7 to 9 years. That's what we're talking about today. Jared, back to you.
Don, we'd love for you to let people know where you're at.
All right, we're staying at Pelican Way Villas. I'm going to go back outside so you guys can see. All right, so folks, this is just one of the balconies. I got one balcony here. I got another balcony over there. That's off my bedroom there, this balcony over here. And when we wake up in the morning, this is what we see. Can you imagine that? Oh my goodness. It's cold at
Don,
home.
it's starting to sound like you trying to relocate.
No. Oh, listen, Kenyatta, guess what we did? We went out and saw some prime property. I think it's about 19 different lots. I mean, listen, frontage, you could see the ocean from it. And listen, I am so happy I came on this trip to find that property. And we're going to see what we can do to bring some additional development. I would love to have a place here year round. And I'm going to be looking at that. And not only that, folks, if everything goes well, we're going to be offering opportunities for you to come here to beautiful St. Thomas Virgin Islands to invest. And how were we able to get here? Oh man, we're able to get here because we're not spending all of that money on interest. I had 4 mortgages not too long ago. We just paid off one of those mortgages in December. How do we do it? Not giving the bank all that interest money. And by doing that, we're taking just a small portion of the interest savings and we invested it in working here for 10 days instead of working in the cold. How about that?
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.